All right, time for today's Hot Picks section of the program. And we're going to zero in on a much talked about area, industrial stocks. Our next guest has three investment ideas with some longer term trends that are encouraging and might actually be minimized on the trade war front that everybody is talking about right now. Maxim Sytchev is Managing Director at National Bank Financial. Nice to see you.
My pleasure.
I know everybody is looking for ways to not necessarily get caught right in the middle of the trade uncertainty. But let's just start with this sector and what is the theme that brings together a lot of the names that you think bode well over the long term?
Yeah, I think first of all, investors have to be realistic because it's, you can kind of ignore, the tariff dynamic, but you can't.
Yeah.
So you have to perceive the reality as it is, not as kind of you want to. And ultimately, what you are trying to actually position the portfolio on individual stocks is looking for themes that have long legs that are going to work regardless of, tariffs, no tariffs, or in certain other situations will actually benefit from that. Supply chain localization, a paucity of labor, so you try to play the automation thematic. That's really the only way that I think one can be positioned, because otherwise you're just kind of chasing your tail and the news flow, because again, the policy uncertainty has skyrocketed dramatically over the last 20 days.
Very true. Okay, well, let's go through these three different examples you brought to the table. I want to start with Stantec. As a reminder, what do they do and why is it that it fits into your hot picks section, if you will?
Yeah, so it's one of the largest engineering companies globally. The other dynamic, which is critical, is that they're selling services. So you cannot put tariffs on services. So 52% of companies' top line comes from the US. So technically, they will actually directly benefit from supply chain localization, more manufacturing capacity going to the U.S. Very strong organic growth in Q4 that just posted a couple of days ago, up 9%. We see a margin improvement opportunity, and also because of the undelivered balance sheet, we think they're going to be able to do more M&A on a prospective basis. And the stock is actually doing quite well, up 9% year to date. It's our best idea in the engineering consulting space. Shares have kind of done nothing in 2024, so right now it's more sort of a rebalancing idea in terms of picking up exposure to a thematic name that has sort of all the positives, while you're still only paying 24 times PE, which from our perspective is very reasonable, given the exposure to water, energy, transportation, buildings. These are all the things that I think the company has a leading position in and will be able to benefit from.
Okay, let's stay with services, because Colliers is also on your list. And I know they're very tied to real estate, but they're helping with the transactions in a lot of ways.
Yeah, and the business has evolved dramatically. So transactions is actually kind of 1/3 of the business.
Okay.
So leasing and capital markets, that obviously has faced the trough a couple of years ago. Right now, that business is rebounding. They're actually scaling up their engineering practice, which actually delves nicely from a cross-synergy perspective. And the other part of the business is investment management, which is 1/3 of their overall EBITDA. So basically,
but all still service related, basically.
Yeah. Well, they actually physically own alternative infrastructure and real estate assets. So here you benefit from lower interest rate dynamic. In fact, Colliers shares correlate negatively to the 10-year. The 10-year is actually down 9% year to date. Ironically, Colliers is actually down as well. So theoretically, it should be a negative relationship. So i.e. Colliers shares should be doing much better than that. They're in a bit of a build period in 2025, but we think they're going to come out very strong as the year progresses. And, the growth opportunity for them is quite large on the engineering side, actually.
Okay, and then the other name you brought to the table today is ATS. How come?
Yeah, so ATS, used to be called ATS Automation, so they actually benefit directly from this labor constraint backdrop. Had a very tough year in 2024 because they had a lot of exposure to the EV space. Right now, that's going to shrink from 30% to only 10% of top line. But the biggest driver of their performance is healthcare, which is 52% of top line. They're exposed to sort of all the stuff from GLP-1 things. Obviously, when COVID was a thing, they benefited from that as well. And as generally speaking, population is people are living longer, not necessarily better.
Right.
Healthcare provides a lot of solutions there. Small exposure to nuclear as well, which is facing a pretty significant renaissance right now.
Yeah.
And food is another significant part of the business, which is pretty stable. So basically, what we're suggesting here is that you're buying close to trough EPS and reasonable valuation on something that hasn't worked last year. So we do feel that certainly the rebound opportunities is quite large. And because they have quite a bit of exposure to the US as well, obviously that whole reshoring thematic should benefit the company on a prospective basis.
Okay, Maxim.